stay on with us. We've got Jaipur coming up, we've got Bengaluru coming up, and we've got a couple of more cities coming up. But let's focus a little bit on our expert segment today, and we're going to talk about property and taxes. There are several reasons why 50% of India's household savings go into real estate. I'm not going to go into the well-known ones like emotional security, the feeling of owning something solid as a hard asset, the pride that we Indians feel in owning a home, etc. What we will focus on is how attractive the government of India has made for us to buy a residential property with Amit Kukreja, CFP and founder of Wellspring Advisors. Amit, thank you very much for being here. Okay, so I can start reading out a long list. Some of them I think are the familiar ones, like when you take a home loan, there's a 1.5 lakh deduction towards interest payment every year. There's deduction of up to rupees 1 lakh towards principal amount. But those are just some of them. There are many more to the list, isn't it? It's a longish list.
Sure. To begin with, if you have a house and you have rented it out, there is a huge advantage. There is no limit on the interest that you pay for the loan that you've taken to buy that house. Second of all, there is a huge advantage in terms of wealth tax. Any property which has been let out for more than 300 days is not considered as an asset which attracts wealth tax. You are exempted from wealth tax. Third one is capital gains. If you have a house, you have bought a house, you are selling it, you can completely exempt your capital gains from taxes if you invest your capital gains into another house. Not just capital gains arising from a house property, but capital gains arising from other capital assets which are not house property. You get huge advantage. Even that can be invested and exempted from tax if you reinvest the entire sale proceeds into a residential property. So if you have a residential property investment, then I think we are very widely and strongly supported by the income tax laws in this country.
And I think a flat deduction of 30% of the annual value of repairs. Let's bring on those graphics as well, because when you're discussing tax, it's very difficult to have a context. So we're talking about tax breaks on rented second home. These are the ones that you can get, and you can of course also get a flat deduction of 30% of the annual value of repairs. Selling a property isn't too bad an idea as well if you do a little bit of interesting buying of another one, isn't it?
Sure, it's not at all. I mean, you can sell it, then you can reinvest your capital gains into another property and then hold it on for a minimum duration of 4 to 5 years, make capital gains, reinvest the capital gains and take out your indexed cost of acquisition, which is tax exempted, and gradually grow your wealth. I think the huge advantage is if you have multiple properties which are rented out, and if these properties are bought on loan, so that your income is not an income, it's a loss from the house property. You can offset this loss figure from your annual salary if you're in a 30% salary or in the 30% tax bracket. So that's the biggest advantage that you have.
The only catch is that if you own multiple properties, more than 2, and if you want to sell the third property, then all the capital gain benefit goes away from all the 2 properties as well.
It depends on the ownership. As a husband-wife, wife can own one, husband can own one.
As an individual, if you own more than 2 properties, even if you have a share in a property, and if you go beyond 2 properties, like you said, multiple properties, then it can be a problem.
Yes.
So I'm assuming that everyone, Samir Jasuja, like you, doesn't own multiple. When Amit and I talk about multiple, it's 2, right?
Or 3 at max, husband, wife and joint.
Wonderful, right, absolutely. Alright, so lots and lots of reasons, and we'll try and get you those graphics. In fact, let's just keep flashing them as we're having this discussion, just to set a perspective for our viewers. Let's bring on the first, second and third one by one. But Amit, so these are the tax benefits that you get. Is that the reason why you see so many high, or let's say upper income professionals going towards real estate? Or is it that they've tasted such good returns which is motivating them more and more towards real estate?
So it's threefold. One is definitely the tangible of an asset, the tangible nature of an asset. Second is emotional security, and the appreciation that we have seen in the real estate market in the last 10 years. I mean, unprecedented. We haven't seen 17-18% plus compounding annual growth rate in residential market before. And third is the tax advantages, obviously. And
so people do consider that in their buying decision. Are tax advantages ever the motivation to buy real estate?
It's not the primary one. It's the appreciation figure which is the motivation.
So it is what they think it will get them.
Correct.
All right. And tax is just an added advantage to that.
That's correct.
So tell me, I mean, when you're advising your clients, because we do a real estate show, so we love property, Samir and I. We keep saying, be cautious. Real estate doesn't give you 18-20% returns in every market. It also doesn't give you 20% plus returns in every period. Having said that, I think we're still very, very towards or tilted towards real estate. Do you find that in India that hunger for real estate isn't going to go away in a hurry, even if people have just made a 10-12% modest return in some markets, they still get pulled to that asset class?
I don't think that hunger is going to go away easily, because if you look at the alternative assets, they haven't performed. With debt markets, they've performed at the rate of 9 to 12% per annum. Equities have just come up recently, by the end of the last year, 2012. So hunger will stay on for the real estate, and there's nothing wrong if you're maintaining your allocation of assets in such a way that you are not desperate to sell out your property and you have the capacity to hold it for 5 to 8 years. The whole cycle of growth comes in picture once you have held the property for minimum 5 years. Before that, it's dicey,
And leveraging too much is again very dicey. You've got to be in your comfort zone when you're investing in real estate.
Absolutely.
You get out of your comfort zone, you get into that game of let's just put 10% in 3-4 projects and hope that they will appreciate even before my next or the third call comes in. That's the dangerous game we say stay away from. Amit Kukreja, thank you very much for being here. Tax is not an easy issue, but we brought you a laundry list of all the things that you should look at if you own a property.